Well, hey everyone, and welcome to today's Explainer. For the next few minutes, I want you to think of me as your personal financial advisor. Today, we're going to embark on a journey together, a journey that takes you right out of that stressful paycheck to paycheck cycle and straight down a clear, actionable roadmap to true financial independence. If you have ever felt totally overwhelmed by money, just take a deep breath. You are in exactly the right place, and we're going to figure this out together. All right, so here's our game plan for today. We've got 5 steps. Number 1, the mental weight of debt. 2, laying your financial foundation. 3, active versus passive income. 4, growing wealth through investing. And 5, habits for financial freedom. Let's get right into it. Section 1, the mental weight of debt. Okay, before we even think about looking at budgets or investment portfolios, we've got to address the elephant in the room, and that's debt. If you are struggling with it right now, I just want to validate that. The psychological toll is incredibly heavy. In fact, I want to pose a pretty surprising question to you. Is chronic debt actually affecting your brain? Because, we often treat debt like it's just a simple math problem. Dollars in, dollars out. But what if I told you it is fundamentally consuming your cognitive bandwidth? Let's look at the data for a second. There was this fascinating study that looked at low-income individuals before and then after they received a one-off debt relief program. Before the relief, a staggering 78% of participants were showing symptoms of generalized anxiety disorder. But after having their debts cleared, that number plummeted to 53%. What this brilliantly illustrates is that getting out of debt isn't just about the math. It's a profound act of self-care. It literally reduces your anxiety and improves how your brain functions. So the crucial takeaway here is that chronic debt creates what researchers call mental accounting costs. I want you to think of your brain kind of like a smartphone. If you have a dozen different debt accounts open in the background, a credit card over here, a medical bill there, maybe a car loan, they are constantly draining your battery. It consumes your cognitive bandwidth, it impairs your decision-making, and it actually traps you in short-term thinking. So if you've been feeling stuck or just unable to focus on long-term goals, it's absolutely okay. Science explains exactly why. Your mental bandwidth is literally being taxed. Which brings us to section 2, laying your financial foundation. Now that we understand the very real burden of debt, let's shift gears and focus on the actionable stuff, building out your roadmap. Think of these 4 steps as your foundational staircase. First step, you have to define your vision. Whether that's buying a house or retiring early, you need a solid why. Second, track your spending with a realistic budget. This is just your map, showing you exactly where your cash is going. Third, build an emergency fund. And fourth, strategically eliminate that debt. The beauty of this is that absolutely none of it requires you to be some Wall Street genius. It really just takes a bit of discipline and a willingness to create some breathing room for yourself. Let's zoom in on step 3 for just a second. An emergency fund is your critical safety net. Ideally, you want to aim for 3 to 6 months of living expenses safely tucked away. This is what shields you from totally unpredictable financial stress, like a medical emergency or sudden job loss. And look, if saving 3 months of expenses sounds literally impossible right now, starting small is perfectly fine. Put away $50. Every single dollar is a step toward your resilience. Regarding step 4, eliminating debt, we actually need to bust a major myth right now. Not all debt is evil. Let's contrast good debt with bad debt. Good debt involves borrowing for things that actually create meaningful growth over time. Think mortgages to build home equity or student loans for a lucrative career path. Bad debt, on the other hand, is the dangerous trap. This is your high-interest credit card debt or loans you took out for discretionary spending, like putting a luxury vacation on a card you can't pay off. That is the bad debt we need to target and target aggressively. So how do we slay that bad debt? Well, here are a few actionable strategies you can use today. You can try the avalanche approach. That's where you attack the debt with the highest interest rate first, which saves you the most money in the long run. Or you can use the snowball approach. That's focusing on the smallest balance first to get a really quick psychological win. And hey, if things are super complex, debt consolidation or negotiating with a nonprofit credit counselor can be absolute lifesavers. Getting organized and prioritizing those balances builds massive, massive momentum toward your independence. All right, section 3, active versus passive income. With a solid foundation under your feet and a plan to crush that bad debt, we arrive at the really fun part, expanding your earning potential. Now, active income is exactly what it sounds like. You are actively trading your time and labor for a paycheck. Your salary, your freelance gigs, commissions, they all live here. But the catch is, if you stop working, the money stops. Passive income, though, That is the holy grail of wealth building. This is money you earn with minimal daily effort after you do the initial setup. We're talking dividend-paying stocks, high-yield bank interest, or rental properties. It's basically setting up a system where your money does the heavy lifting for you. Think about it this way. Relying on just a single source of active income is kind of like sitting at a table with only one leg. It leaves you incredibly vulnerable. If that one job disappears, the whole table falls over. I strongly encourage you to diversify and build more pillars of support. Combining your active paycheck with growing passive income streams is the ultimate way to accelerate your goals, build up your resilience, and frankly, buy back your time. Section 4, growing wealth through investing. Okay, so how do we actually create that passive income? I want to assure you right out of the gate, investing is absolutely not just for the ultra-rich. It's an accessible, downright mandatory tool for everyone. Let's break down 2 very common ways to invest. On one side, you have individual stocks. These carry a higher risk level, and you're the one managing the research. Plus, to get good diversification, you need a lot of upfront capital to buy into dozens of different companies. On the flip side, we have mutual funds. These pool money from a bunch of different investors. They offer a lower relative risk because that much-needed diversification is built in from day one, and they're managed by professional fund managers. For a lot of folks who are just building their foundation, mutual funds keep the cognitive load nice and light while still providing really steady growth. But honestly, whether you choose stocks, mutual funds, or just an employer 401k, the real secret sauce is compound interest. This is the mechanism where you earn returns not just on your original money, but on the growth that money has already accumulated. It's literally interest on top of interest. Starting early and staying consistent makes compounding work exactly like a snowball rolling down a hill. It just gains massive size and speed over the years. Finally, Section 5, habits for financial freedom. So you've built the foundation, you're attacking your debt, and you're investing. Awesome. But to sustain this long term, we've got to play a little defense. You need to aggressively avoid these frequent traps. First, don't overlook those sneaky, small, recurring subscription expenses. $10 here, 15 there, it adds up incredibly fast. Second, never neglect your insurance or health costs. One emergency without proper coverage can literally wipe out years of your hard work. Third, don't delay your investments. Procrastination just robs you of that sweet compound interest we talked about. And finally, beware of lifestyle inflation. Just because you get a nice raise at work doesn't mean your spending has to rise right along with it. I absolutely love this quote. Treat saving as a fixed expense. You've got to reframe your mindset here. Your monthly savings contribution should not be whatever happens to be left over in your checking account at the end of the month. No way. It should be a non-negotiable monthly bill that you pay to your future self. Automate the whole process. Set up automatic transfers so that the money moves over before you even have a chance to spend it. Look, along the way, you are absolutely going to make mistakes. An unexpected expense will pop up, or the market will take a dip. It happens to everyone. The key is to adopt a growth mindset and view these setbacks as learning opportunities, not permanent failures. Resilience, a little bit of patience, and continuous financial education, that is what builds a truly unshakable foundation. Ultimately, I want you to remember this. Building wealth, it isn't actually about the numbers sitting in a bank account. True financial freedom empowers you to live intentionally. It buys you flexibility, it buys you peace of mind, and it gives you the ability to make life decisions based on your deepest values, rather than what a restrictive budget tells you that you can or cannot do. So as we wrap up this explainer today, I want to leave you with a rather provocative question to really chew on. What does your unique vision of financial freedom actually look like? Is it traveling the world? Is it starting your own business? Or is it simply sleeping soundly at night knowing you're secure? Take a minute to define that goal today and take your very first step toward building your wealth. Thanks so much for hanging out and learning with me.